This Wednesday, the ADP jobs data, often called the mini non-farm payrolls, was released. Especially the US ADP employment for May rose by just 3,700. That's below the previous 6,200 and far below the expected 114,000. It's the lowest since March 2023, well below market expectations. This shows the labor market is clearly losing momentum. At the same time, the Institute for Supply Management ISM released its data, showing the U.S. services PMI for May fell to 49.9. This is the first contraction in the services PMI in a year, but what the Fed cares about the most is still Friday's main jobs report. The non-farm payrolls are out Friday night. Compared to the other two, the Fed focuses more on this one. However, weak data like this has increased the market expectations for a rate cut this year. After this data were released, who was the happiest? It was President Trump. Once the data was out, he once again called on Fed Chair Powell to cut rates immediately. That's why he's happy, a rare chance to pressure the Fed. However, it's worth nothing. Lately, Trump has repeatedly urged Powell to cut rates, even openly threatened to remove Powell, but Powell remains tough. He stands firm despite frequent pressure. He's unmoved. Powell stresses the Fed's independence, saying monetary policy must be guided by real economic data, not politics. But the market, in response to the ADP data, reacted somewhat irrationally. What's certain is Wednesday was definitely a day driven by economic data. It was a trading day shaped by major market moves. The market had this question: why did the U.S. secondary ADP data, this less important job number, fall short of expectations and cause such a big move before the open on Wednesday? Let's take a look. If you look at the Nasdaq index before the open, it was dropping. All three indexes dropped. Here's the Dow Jones, which dropped even more. The day before it was already trending down. The Dow was in a downward move. The Nasdaq was the same. Before the open, its decline was clear. This was the situation. That drop at the open was pretty sharp. Not just the Nasdaq, the S&P 500 showed the same thing. Why did we see this kind of plunge during the session? Many people were puzzled. A spike in employment should make a rate cut more likely, shouldn't it? Rate cut expectations rise, so the market should be bullish. A rate cut brings more liquidity. That's good for stocks. It's a bullish signal. So why did the market plunge instead, almost like it was booked? In fact, right now the US stock market isn't afraid of the Fed holding rates steady. No fear if rates stay unchanged. As long as there are no more hikes, even if rates stay high for 100 years, US stocks will still go up. But why did the market react so negatively? Why was sentiment so weak? Mainly because after the ADP data was released, the market started worrying about a possible US economic recession. Recession fears grow. The jobs data pointed to a potential downturn. Fortunately, the ADP number is just a small sample, not the official data. The Fed focuses more on Friday's main jobs report. So the drop we saw in US stocks was really just a minor pullback. It's just that the market is pricing in possible recession risk. That's the expectation, but the key is still Friday's main non-farm payrolls. If that data also disappoints, then expectations for future Fed rate cuts will soar. Those expectations could directly boost US stocks. That market sentiment could lift equities. So how would a Fed rate cut affect US stocks? A lot of investors are focused on this. What would a Fed rate cut mean for US equities? What exactly would happen? We need to analyze this in detail. Let's break it down. If Friday's jobs report turns out much weaker than expected, and the market expects the Fed to cut rates soon, that shift in expectations could drive sentiment. So that market sentiment, how would it actually move US stocks? That's what we need to consider. The Fed has been signaling to the market that a rate cut is likely. So if the odds of a Fed rate cut keep rising, what does that mean for the US stock market? A Fed rate cut can have a dual impact on US stocks. The effect is two-sided. It depends on the reason for the rate cut, the economic backdrop, and the market expectations. If it's a preemptive cut, for example, when the economy isn't in recession, then stocks usually go up. A rate cut in this scenario often boosts the market. But if it's a rescue cut triggered by a major economic crisis and used as emergency support, that's a different story. It could trigger market panic and send stocks lower, so it really depends on the context. What is a preemptive rate cut? It means cutting rates before a clear recession hits when there are only potential risks. A cut like this can boost the liquidity and strengthen market confidence. That usually pushes US stocks higher. For example, after the first rate cut in September 2024, when borrowing costs dropped, tech stocks benefited the most. The tech sector performed very well, especially the major US tech giants. This helped drive a strong market rally. If it's a rescue cut, meaning the cut mainly aims to fight a hard economic landing or financial crisis or some other major risk event, the market may take it as a sign the economy is getting worse. This can trigger a sharp sell-off. For example, in December 2024, after a third rate cut, the Dow Jones fell more than 2.58% in a single day. So after the Friday's data comes out, the market expectations for a Fed rate cut could rise sharply if the numbers are poor. If a rate cut becomes more likely, what does that mean for the future? What will the rate cut look like? Based on the current situation, it won't be a rescue cut. Right now, the US economy hasn't seen any major shocks or black swan events, so it's not about emergency easing. It would be a preemptive cut if it's a preemptive move. Even if the market expects a possible US recession ahead, there's no major problem yet, no major crisis. So what's the message to the market? It signals some added liquidity. It's to help prepare for possible recession risks. The US might inject liquidity in advance. They will start easing early. They will release liquidity through various measures. In the short term, this can simulate some economic growth. For the stock market, it brings more liquidity. This is generally positive for stocks, so that's the main direction we can expect. The key is Friday's non-farm payroll data. Once that report comes out, there are two scenarios. If the data is strong, the opposite of the weak ADP numbers, and it shows robust growth, it will quickly boost market confidence, especially in the two major indexes, the Nasdaq and the S&P 500, which are both near record highs. If that happens, what does it mean for the market? Strong jobs data signals a strong US economy. That gives the market a lot of confidence. Optimism could surge in the short term. A breakout in the Nasdaq is highly likely. Chances are very high. It could test the previous high at 20,118. If it breaks through, that would bring even more confidence to the market because it would set a new high, a historic high, right? That shows US stocks remain strong. It demonstrates continued market strength. Globally, this could attract more capital inflows. So everyone is watching Friday's data closely. Market attention is extremely high. If the market data falls short of expectations and is weak like the ADP report, it would show the economy is slowing. At that point, the Fed might be more likely to cut rates, and that probability rises. Market expectations for easing will increase, but in this scenario, what will benefit the most is market liquidity. However, compared to expectations of a strengthening economy, this effect is weaker. So even with Fed rate cut expectations, the market's upward momentum will be much less than if the data had been strong. Performance will lag last week's optimism weaker than before. So for this upcoming Friday's non-farm payrolls, if the data disappoints, the market's rally will be limited. It will be hard to break through resistance. It won't give the market strong confidence. Most likely, we will see only a slight uptick and then it may pull back. At best, it could just consolidate at high levels. Sideways trading near the highs is also possible. If the data is very strong, then with that momentum, it would show the US economy is solid, and the Nasdaq could challenge its previous high. There's a chance to break out. If that happens, it would bring even more optimism to the market. It will also attract more buying. That's our current view on the future direction of the US stock market. That's a general outlook. Right now, from a technical perspective, the Nasdaq is stronger than the S&P 500 and the Dow Jones. It's relatively more resilient, wouldn't you agree? Looking at the Nasdaq Composite's current performance, it's showing clear resilience. Because right now, even though the recent data wasn't great, both reports came in weaker than expected. Yet despite the soft data, the Nasdaq managed to bounce back. In the end, it was still able to close higher. That highlights its growth resilience. But right now, the Nasdaq's performance is also a bit tricky. It's in a delicate spot. If the data is strong, it confirms the economy remains solid, just as we discussed. So the index could likely challenge its previous high and drive more market momentum and greater optimism. But if the data disappoints, it suggests the economic fundamentals are worsening. Still, rising data cut expectations will bring more liquidity. At that point, it's positive for tech stocks. It may lift a short-term sentiment in the market, but a true breakout to new highs would lack enough momentum. there just won't be enough strength. So, in my opinion, personally, as long as the main jobs data is strong and shows clear growth, that's the best for the US economy. Because when stocks rise on weak data and rate cut hopes, the rally lacks real support. There's no fundamental backing. If the job data isn't too bad, the US economy shouldn't deteriorate much. So while the market wants to go higher, it needs strong fundamentals for real support. Without that, further gains are difficult. It's tough to push higher. That's our current view. Where will US stocks go from here? Friday's non-farm payrolls data is crucial. That's why the whole world is watching. Everyone's focused on Friday's outcome. And as for us, we will be watching closely too. If you have other thoughts or opinions, feel free to leave a comment below. Let's discuss together.